Here we have a diagrammatic representation of accounts. As discussed earlier, accounts are of three types. So let us repeat it again. First account type is what? Yes, students, you are correct. It is personal account. The second account type is real account, and the third one is actually called as the nominal accounts. So personal account is nothing but an account which is related to an individual person or a firm is actually called as personal accounts. Here the golden rules tells that debit, we have to debit whom? The receiver, the fund who is receiving it, he must be debited, and who is giving that particular source of fund, we have to credit him. So this is the rule of debit and credit for personal account. Similarly for real account, debit is nothing but what comes into the company, that is actually debit, and which goes out of the company we are supposed to credit. This is for the real account. Similarly for nominal account, we have to debit all the expenses and losses. Similarly we have to credit the income and profits. So this is the rule for the debit and credit. It's actually called as the golden rules of debit and credit. Let's discuss this one more time. See, as I said you, this is nothing but the golden rules of debit and credit. So in case of personal accounts, debit means what? Yes, we have to debit the receiver. In personal accounts, credit which account? The giver. Similarly in real accounts, what we have to debit? What comes inside. And which one we have to credit? We have to credit what goes out of the company. Next is nominal accounts. Nominal accounts, according to this, all the expenses and losses we have to debit. Similarly, all incomes and gains we have to credit. So this is the golden rules of debit and credit. The transactions actually are recorded first into the journal book. So journal entry is nothing but it is the primary book of accounting. What is this journal book actually called as? The primary book of accounting, because here only the first transactions are recorded. So what it contains? It contains the chronological records of the transaction. So every business has what? It has two folds of aspects. One is the receiving. Company is receiving. So the receiving aspect, and the second one is giving. The company is giving. So these are the two aspects involved in every business. So one has to give something to another person in order to receive something from him. So this is that is giving and receiving both has to be equal. That is, receiving has to be equal to giving. So now let us see how transactions affects the accounts. That is, any transaction, simple transaction you take, it will affect two sides, that is the debit aspect and the credit aspect. So here is an example. You can notice here the example involves these transactions, which I will try to explain you, make you understand how the transaction goes. So the first example here is a person is starting the business with 10,000. So this will be the capital investment. Then he has purchased some goods worth 4,500 on credit from a company or other creditor called as XYZ. Similarly, he has sold goods worth rupees 3,000 to Y on credit. So these are all transactions. Similarly, he has opened up a bank account with State Bank of Mysore, okay, by depositing amount of 2,500. So these are the monetary transaction examples. Similarly, so the fifth transaction here is he has paid 1,000 salary to an employee in cash called as Puja. Then similarly he is receiving a check from Y previously to whom he has sold the goods, and the amount is rupees 3,000. Similarly he has received commission from Anil of rupees 2,000. Similarly he has paid rent 500. So these are the monetary transactions which are involved in the company. Similarly, ninth transaction involves withdrawal of money from the bank. Then 10th one is, since we had purchased goods from XYZ for 4,500, we have to pay him. So a check is issued for 4,500. So these are the example transactions. So this, according to accounts, how we are supposed to maintain that, we'll see shortly. We'll be discussing about the accounts foundation or foundation of accounts. I am your master faculty Pradeep. So let us continue with the topic accounts foundation or foundation of accounts. So in the previous class we were discussing about transactions and how these transaction affects minimum two accounts, that is the credit and debit aspects, how they are involved. So let us see now. So this was the example I was discussing with you. So a business starts with cash of 10,000 and the next transaction is goods are purchased worth 4,500 on credit from a company called as XYZ. Then the next transaction, goods are sold worth rupees 3,000 to a company or called as Y on credit. Similarly, fourth transaction, a bank account with SBM, that is State Bank of Mysore, is opened with a deposit of 2,500. These are examples of transactions. The next transaction, salary rupees 1,000 is paid to Pooja, the employee, using cash. Next transaction, check of rupees 3,000 is received from the company Y for whom we had previously sold goods. Then next we are receiving commission from a person called Anil and the amount is rupees 2,000. Similarly, next transaction we are paying rent of 500. Then the next transaction we are withdrawing 1,000 rupees from the bank account, and then finally we are issuing a check for rupees 4,500 to XYZ company for the goods which we are purchased from them. So this how accounting wise which will be the debit and which will be the credit account, let us find out now. So notice here the first transaction, there actually what is happening is capital investment or capital investment is taking place. So here the accounts involved is cash and capital. So in cash you can notice that cash is nothing but a real account and capital account is actually a personal account. So these two are the accounts getting involved. So according to this the rules of debit and credit changes. So according to the real account, debit will be what comes in, and since capital is personal account, here credit becomes the giver. So this is the concept of the rules of debit and credit. So in the next transaction you can see purchases is happening. So purchase account is actually a real account. Here debit what comes in, then XYZ is the sundry creditors who is selling the goods to us, so it becomes a personal account. According to them the credit is giver. Similarly, in the next transaction Y is actually buying goods from us, so Y becomes personal account. So according to that the debit the receiver, and sales account becomes the real account. So according to that it becomes that is credit what goes out. So this is how it reflects. Similarly, we are opening a bank account in State Bank of Mysore. So State Bank of Mysore becomes a personal account. So here debit the receiver. Similarly, cash is a real account. According to that, what goes out, that is credit what goes out. Similarly, you can notice here salary account. So salary account is a nominal account example. So here we have to debit the expenses. Similarly, cash. So cash is a real account. So in this case what happens, we have to credit what goes out. Next transaction, we are receiving check. So according to that, State Bank of Mysore is actually a personal account. So here debit the receiver. Next Y is paying us the amount, that is company Y is a personal account. So because of which we have to credit the giver. Similarly, in the next transaction you can notice, so here commission is actually received from Anil. So commission is received in terms of cash, right? So cash is real account. So because of which we have to debit what comes in. Then what are we receiving? We are receiving the commission. Commission is actually nominal account. So here credit the incomes. The next transaction, here we are paying rent. So rent is nominal account. So debit expenses. So whatever the expenses is, we have to debit it. Then next cash account. So here cash account is real account. So we have to credit what goes out. From the cash account, the money is going towards the rent. Next transaction here, cash account is the real account, we are debiting it, so what comes in, then State Bank of Mysore is a personal account, we are crediting the giver. Similarly, in the last transactions, it is actually XYZ is the company, so it's a personal account, here debit the receiver. Similarly, State Bank of Mysore is also a personal account, so we have to credit the giver. So this is how the two aspects of debit and credit acts depending on the type of account. What type of account you are dealing on, that the rule of debit and credit changes. So as I told you earlier or explained you earlier, there are three types of accounts, that is real account, personal account and nominal account. So according to which the rule of debit and credit changes. So this example would have made you understand that. Now let us see. So here is an example of journal entry. So the journal entry format, how we have to write all these transactions. Let us see. That is the above transactions, what we came across just before. So according to that, you can see here, we are supposed to debit cash account and credit the capital account of the company. So you can notice here, debit side, the amount is entered here, 20,000. Similarly, the credit side also, the amount 20,000 is reflecting. So this is actually called as double entry system, wherein in the double entry system, we are equally balancing the debit side as well as the credit side. The next transaction you can see here, purchase account, we are debiting the purchase account and we are crediting the XYZ company from whom we are buying the goods on credit. So you can notice here, both the sides the amount is clearly mentioned, that is 4,500, that is debit side as well as the credit side. So this is how the journal entry is passed. Similarly, the next transactions, you can notice here 3,000 rupees of goods we have sold to Y company. So you can see Y account we have debited 3,000 and we are crediting simultaneously the sales account, that is with 3,000. So this is how both the aspects, the debit as well as the credit aspects takes place. So similarly, you can notice here, we are opening one new bank account with State Bank of Mysore here. So first we are debiting it with the amount 2,500, and where are we taking that money? We have to credit, that is nothing but the cash account. You can notice here we are crediting 2,500. Same way, we are paying 1,000 rupees salary to Pooja. So we are debiting the salary account with 1,000 rupees and we are crediting it from our cash account. So this is how the transaction has to be passed on. That is, the transaction, because of the double entry system, will have both the aspects of debit and credit. Similarly, the next transaction you can see here, we are receiving 3,000 rupees from the company called as Y, to whom we had sold the goods earlier. So we are debiting our bank account with 3,000 rupees and that we credit it to Y's account. So what happens, earlier he is supposed to pay us the money, right? Now once he has paid here, it gets equalized and the balance which the Y company has to give to our company will become 0. That is 3,000 minus 3,000. That is, there is no more balance for them to give as of now. Next, similarly, you can see in the next transaction here, we are receiving the commission actually. So if we have to debit our cash account here and we have to credit the commission received. So actually commission we are receiving it from Anil. Okay. So the amount which we are receiving here is both the sides reflecting 2,000 rupees, debit side as well as the credit side. So in the journal entry format, this is how we have to maintain. So similarly, next we are paying rent. So we are debiting the rent account and we are paying that with help of the cash account. So we are crediting it. So here you can notice both the sides, the amount is reflecting debit 500 and credit 500. Similarly, next we are withdrawing cash from the bank account, State Bank of Mysore. So since we are withdrawing, we have to debit our cash account and we have to credit the bank account. So 1,000 rupees we are debiting and crediting 1,000 rupees. Last transaction, we are issuing a check to XYZ company for the goods which we have purchased from them. So we are debiting that account. And where are we paying that from? We are paying that from our bank account through check. So you can mention here being paid. In every transaction in journal entry, we will mention it by using the word being in the narration. So 4,500 is debited and credited. We pass on. So in every journal entry, the narration will actually always start with the word being. And what is the narration? We have to mention, we can mention it. Being cash paid to or being cash received. So this is the example of how we can generate the narration for the transaction. So next topic is ledger. So what is this ledger? So ledger, as I discussed earlier itself, it is a book of accounts. It is one type of book of accounts wherein all the transactions, that is the transactions which is passed on in a cash or non-cash or cash or bank book, and the journal book, whatever the transactions we record, so both are clubbed together and recorded into the journal ledger. So journal ledger is the place where we get all the transaction information. So here we can say that the clubbed information of individual accounts and other posting, everything is done. That is cash or bank book transactions as well as the journal book transactions are entered into the ledger. So here posting means what? The entry posting means nothing but transferring of both debit and credit entries from the ledger as well as the non-cash or bank book entries into the ledger. Next. Trial balance. The next concept is trial balance. What is the trial balance? So as I mentioned, when we start maintaining the accounts using the books of accounts over a period of time, and then when we start the entire ledger transactions, when we summarize it, then out of which we can prepare the trial balance. So trial balance is nothing but it is a statement which contains various ledger balances on one particular time period or particular date, as of a particular date. So this is actually called as a trial balance. So the next topic is the financial or the final statements of accounts. So which are the final statements of accounts? As I informed or as I discussed with you earlier, the final or financial statements of accounts are the profit and loss accounts or the profit and loss account statement, and then the balance sheet. So after we prepare the trial balance, using the trial balance and the various accounting formulas and rules, we are supposed to prepare the financial statements of accounts, that is balance sheet and profit and loss account. So here trial balance actually checks the accuracy of all the book entries. Whatever entry we have done in the different books of entries or the ledgers, so here trial balance is going to help us to check that accuracy. Then after that, to find out whether our business is in a profit state or whether it is in a loss state, for that purpose a trading and profit and loss account is prepared from the trial balance. So what is prepared? A trading profit and loss account statement is prepared from the trial balance. So what is the financial position of our business? How do we judge? We judge that by the balance sheet of our business. So by just referring to the balance sheet of our business, we can find out what is the financial position of our company or our business. So the final statements or final accounts, which are the final accounts? Trading and profit and loss account and the balance sheet. What is trading and profit and loss account? It is a nominal account which has the gross profit and loss and the net profit and loss, which we can understand by that accounts or the statement. Similarly, what is balance sheet? Balance sheet is the statement of assets and liabilities. So this is the final position of the business we can understand from a balance sheet. Accounts. Next is the adjustment entries. What is this adjustment entries? So whenever we are preparing the profit and loss account for a particular time period, so it is absolutely necessary for us that all the essential expenses, losses, incomes, gains, everything is related or considered for that particular time period only. So because of this, what happens? whatever the figures we are getting in the trial balance, we have to adjust its, we have to make the trial balance figures adjustment so that we can prepare the financial statements of accounts, that is profit and loss account or the profit and loss statement, account statement, and the balance sheet. So entries whatever we have passing, we have to check and make the necessary adjustments so that we get the proper or the correct trial balance, and out of the trial balance we can prepare the final statements of accounts, that is profit and loss account and the balance sheet. And these entries usually are related to what? They are related to the closing of stock, outstanding expenses, prepaid expenses, outstanding or occurred incomes. So these are the entries gets involved with it. And other things which are involved in this are income received in advance, whatever income you are receiving in advance, depreciation, bad debts, then the provision for bad debts. If bad debts occurs, or what is the provision to recover them, show transaction towards that, and then the interest paid on capital. So the next topic which we are going to discuss in accounting is the account groups. So this is very important. See, before we could start either manual method or system method of accounting, whether you want to maintain accounts using system method or manual method, you need to have first the basic knowledge of the account groups or the classification of accounts. I told you, the steps involved in accounting. The first step is what? Classification of accounts. We need to know how to classify the accounts. So account groups in general, see, we can say that they are very, very essential. Only if you understand the concept of these account groups, then it becomes easy whether you are maintaining it manually or using the system method. So when we talk of system method, Tally comes into picture. So Tally ERP 9 or Tally Prime or any other older version or any the upcoming new versions. So whichever version of Tally you need to use for the system method of accounting, you need to understand that we need to have a clear picture of what is account groups. So under account groups, there are two types. One is called as the reserved groups. Reserved groups are nothing but the reserved groups that goes into balance sheet, and the other reserved groups that goes into profit and loss account. So leaving this, the other type of account groups which we create, that is actually called as the user defined groups. And these user defined groups also are nothing but the groups which goes into balance sheet or profit and loss account. So this is the boundary. Leaving this boundary, we never go out. That is, the account groups are actually of the types assets. These are the four main account heads, we can say. Liabilities, income, and expense. So these are the main account heads. So this is, you can consider this to be the boundary. Whatever the new account type which we are going to create, that will come under any of these four account heads only. So now let us discuss about the reserved groups which goes into the balance sheet. That is, the reserved groups which are involved in balance sheet. About that, let us discuss. So the first account group which we are going to discuss is the capital account. So capital account is nothing but the investment, whatever we make to start the business comes under capital account. So under capital account, one more subgroup we have, that is called as reserves and surplus. So whatever reserves you are saving for the future use or future plan, that comes under reserves and surplus. Similarly, we have a account group type called as current assets. So current assets are nothing but the assets which we can use immediately. Under this comes bank account of the company, cash in hand account of the company, deposits on the asset sides, loans and advances on the asset sides, stock in hand, sundry debtors. These are all types of current assets. 6 subtypes, or you can say 6 different sub types of current assets. Next, we are talking about current liabilities. Current liabilities means the liabilities which we are currently liable to pay to others, that is actually current liabilities. Example, duties and taxes. Though taxes and all, no, we are supposed to pay them immediately, right? So that is under current liabilities. Similarly, provisions. So you have a bad debt provision or some other provision which we need to pay them. So that liability type of comes under current liabilities, that is provisions. Then sundry creditors. Sundry creditors are nothing but the trading accounts, that is the suppliers, those who supply goods to us on credit basis. They are actually called as sundry creditors, to whom we have to pay the money which we have taken on credit, that is which the goods which we have purchased from these companies on credit. This in a stipulated time period we have to return them back. That is why it is under current liabilities. Assets means what the company is having. Liability means what the company is supposed to pay to others or give to others. Next, fixed assets. Fixed assets are nothing but it is an account of assets what the company is having, like for example furniture, building, machineries, plant and machineries. All these comes under fixed assets. Next is loans under liabilities. So loans under liabilities, there are three types. One is bank OD account. Bank OD account means bank overdraft account. So companies account, if they need some money, they can take it from an overdraft account of them. So but the overdraft account or the provision will be given to a company which has been maintaining their accounts in a same bank over a time period, and their transactions with the bank and their balance sheet or the financial year records are good. Then next is secured loans. Secured loans are nothing but the loans taken on some security, that is by providing documents. Unsecured loans are nothing but the loans which are taken without any provision of documents or anything, so just verbally taking up. They are called as the unsecured loans. Next type of account group is investments. So all investment related accounts comes under this. Next, branches or divisions. If the company is having a branch or a division, those type of accounts comes under this. Miscellaneous expenses, asset side. So expenses which we can't specifically credit, those type of expenses are known as the miscellaneous expenses. Suspense account holds suspense transactions which are not of certainty. Then next reserve group set which we are going to discuss is the reserve groups which goes into profit and loss account. So under profit and loss account, as I said you, the main account heads which is getting involved is incomes or expenses. So under this, the account group types are sales account, direct income, indirect income, purchase account, direct expenses and indirect expenses. So these all are the reserve groups that goes into profit and loss account statement. Then as I said you earlier, the entire this accounts is actually classified into account heads. Then these account heads actually lead to account groups. Under these account groups we create the ledger books. So in computer system, say example, if we are using the Tally software, so in the computer or the system method of accounting, the accounts is actually classified into account heads. Which are the account heads? I explained earlier. The account heads are assets, liabilities, income and expenses. This is the four main account heads. These are only classified into account groups, and further these account groups leads to ledgers. We create ledgers under account groups. These account groups falls under the concept of account heads. To make you understand this in a simpler procedure, so I'll try to explain this with a real world example, but this real world example is only for you to understand. This you cannot consider it as a concept, right? So I'll tell you the concept. See, when we are studying a particular standard or class, see, we have different subjects, and for these subjects we use different notebooks, and to write the notes into the books we use different kinds of pens, right? So this is how we can consider that the classification of accounts gets involved. Say the subject, the main subject, we can consider this as suppose account heads. For example, we have science. The subject, main subject is science, right? So this is only for the example sake, for you to understand the concept how the account heads, groups and ledgers are related to one another. For that purpose I am trying to explain you this. Let me erase this. See, the account head is something like a subject. Say the subject is science, right? The account head is something under the classification of the subject. Like say in science we have 3 branches, say physics, chemistry and biology. So you can consider that the account head is like a main subject and account group to be sub topics or the sub classifications. Like under science we have physics, chemistry, biology, right? So similarly ledger is nothing but the book. Say physics is having 2 books. So one is the physics textbook, another one is the workbook. So you also have notes which you prepare. So this how the books are involved. So this is how the ledgers work. You have different books for different purpose, right? Same way you have different ledgers to maintain different kinds of accounts. So this is how the classification goes. Okay, see this concept of subject and the topic and the book, no, I have explained you to make you understand the concept how account head leads to account groups and account groups leads to ledgers, and ledger is actually the book where the transactions are recorded. And how is that transaction recorded means with help of vouchers. Like how will you write the notes? You will write the notes using what? Pen, pencil, scale and the different instruments which are required to make the notes, right? The pen also can have different colors, red pen, black pen, green pen, right? So according to that only, here to make the entries into the ledger, entry where we make into the ledgers. So to make the entries into the ledger we need the help of vouchers. So vouchers, there will be different types of vouchers to record different types of transactions. So this is how the concept of account heads, groups and ledgers gets involved. Clear? So let us continue, students. So as I said you earlier itself, the accounts heads is classified into 4 types, which are there. Assets means what the company is possessing, liabilities what the company is supposed or liable to give to others, income what the company is earning, expense what the companies are spending or making expenditures. So account groups in Tally I have already discussed with you. There are 2 types. One is the reserved groups and the other one is a user defined. Reserved groups means which are already existing in Tally. So these groups you need not have to create them in Tally. They are already there. We need to just create groups under these subgroups and ledgers under this and continue with our accounting process. User defined groups means the one groups which we create. Leaving the reserved groups you need other type of group, then we create. But the user defined group also comes under these account heads only. That is either it will be an assets or liability or it will be an income or it will be expense. It will not go outside this boundary. Okay. So in Tally or Tally ERP 9 or Prime, any version you take, reserved groups, how many reserved groups we find? We find 28 reserved groups. So this is very, very important. We call this also as predefined groups. Means when you create the company, automatically the application creates these groups. Without this, we can't maintain accounts. This is the basic structure we can say. So without these groups, we cannot maintain accounts. That is why they are called as reserved groups, and they are predefined or they are created automatically as soon as we create a company. So this comes under the accounting heads. As I said, I'm repeating this again and again. It falls under either assets, or it falls under liabilities, or it falls under incomes, or it falls under expenses.